Good morning. This is the Eye of the Storm podcast with the Elliott Wave weekly update for the NASDAQ 100, being recorded on Saturday, February the 21st at 8:07 a.m. Pacific Standard Time. I'm here on my maximum monthly chart of the NASDAQ, but what you might notice first is that I've kind of removed all of my indicators, which are basically the moving averages and an RSI down there on the bottom. This basically just kind of leaves us with, let's get rid of that. Leaves us in a position where we get to see just the Elliott and the wave pattern itself. So I'm going to start here again on the cash market. I'm starting from the maximum amount of data that I have and realizing, number one, that the NASDAQ 100 began as an index in 1985. So from that level, we have much less time than, say, the S&P 500 or the Dow Jones, which the data goes back. The S&P is 1928, when it was, by the way, not the S&P 500, it was the S&P 90. So they started a separate index for 90 stocks at that time, whereas the Dow has always been 30. Those stocks rotate, of course. Some drop, some are added, and that has always been the way all of these indexes function. And so again, the S&P 500 actually came into existence as an index of 500 stocks in 1957. Prior to that, the data that was collected was based on the S&P 990. So much smaller index, but still was tracked. And that's what we use going back to 1928 to current. So all of that into what we're doing here in the NASDAQ. In the NASDAQ, again, starting in 1985, and the futures market actually didn't start trading until the late 90s. So again, limited amount of data to put in or to lift this index on the same wave count as the others. What it is doing, by the way, though, under my view, is that the NASDAQ is finishing a primary third wave and not a cycle third wave. Why? Because of the length of time in existence. So, nonetheless, I would anticipate that we're going to get, like in the other markets, a steep corrective pattern, which should begin anytime soon. I do believe that we are still in that topping process. As much as we can have an alternate or even a preferred count that suggests that the highs are in. I see that. I hear what you guys are talking about. But right now, I'm continuing to leave potential for additional upside to occur. Now, I can add into this that on Friday, we actually had two incidents of what should have produced much larger moves than actually occurred. You might want to say, well, why? Why did we get muted responses to what really is happening? And several things come to my mind. The first being that it's algorithms, the second being that Friday was an expiration, and the third being is that they had already determined where things were going to be. So we got the GDP number, and if you notice, it didn't spike lower after it. It just kind of walked itself down. It was consistent, but it was down, 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 down. And I'll tell you what I saw happening there. It was just going through some gamma levels, either individually in the stocks or collectively in the index. And it just caused some adjusting, some changing of positions, some getting out, some monetizing, whatever what took place did take place. Then at about 10 a.m., we got the Supreme Court ruling on the tariffs. And sure enough, as I've been talking about that, if the tariffs would have been taken down, declared illegal, and beyond the power of the president to use the statutes that he was using to put them in place, that we would get a spike higher. Because essentially it's like you can't tax like that. And so that's exactly what we got. As a matter of fact, it was something I was watching at the time where suddenly the markets went from being slightly lower to being way up there. And what was the next step? The next step was that it just got sold off all the way back down to where it was prior to the news. Does that diminish the news? Not necessarily. But it did fall right at a point where the market was dealing with an expiration. And since there wasn't really any groundwork to say, okay, we now can go buy all these different things and push this market higher because of this, of what maybe will residually happen moving forward. Well, without that evidence, the market was like, no, we got to go back to what we were doing, which is dealing with today, and that was expiration and certain levels on facts that they kind of know, what their position is, what's going on. So again, that's what took over. Now, it was a great move up, but we came all the way back down and then we rallied back up. But that again goes back to what also took place last week on Wednesday when we had the volatility expiration. The VIX expired, those options expired. And what happened after that, it was picture perfect because what was looking for was once all of that volatility and those options expired, that we would get a pop in volatility and a slight drop in the markets. Well, that's exactly what we got. And then it turned. And then it turned and we began to rally and we rallied strongly. Why? Because of other volatility, other gamma positions in the market that needed to be dealt with. And that's what happened. Then we started to come back down again. So these things just kind of go and play hand by hand. But the theory was, if we remember, that at that time, because when a VIX expiration falls on the third Wednesday, right? So, but if it falls before or after the monthly expiration, in this case, it came before. So the VIX expiration was on the third Wednesday, and the monthly expiration is always on the third Friday. But depending on how the calendar comes in, right? So if we come in, particularly where the first of the month is like on a Thursday or a Friday, or even a Saturday, some at the end of a week, that third Friday is going to come after the third Wednesday, just because numerically how the month is set up, right? So you can go in and you can look and you can check this out. So that is more the norm, that the options expiration is going to come after the VIX expiration. And so that norm then tells us that we get not the same type of a response. But let's just say as well that it's not ground in stone that that's what happens to the market. It's just what the perception is, and therefore we can program algorithms. We can program ourselves as like, oh yeah, you're going to get this reaction, you better go with it, and all of a sudden it happens. But there's no real ground facts that go behind it. So here we are. Now, getting back to what we got to deal with now. I do think that we're going to have the weekend, right? But we're already hearing from the president, and we can go right there and see what he's saying. Said effectively, immediately, he's raising the 10% worldwide tariff on countries, many of which have been ripping the U.S. off for decades. Wow, on and on and on. So without retribution until I came along. I'm reading. This is the quote, folks. You can read it right with me. To fully allowed and legally tested 15% level. So here we go again. Now, what normally happens when we start playing the tariff game? And now it's payback time, right? Now we've interrupted and we've bruised an ego here. So, oh no, I'm going to get you. I'm going to get you. I'm going to have my tariffs. Okay, fine. You're going to get your tariffs, and the market's going to tell you what it thinks about them. Just like you think you're going to pull all this money and you're going to create a great economy, or are you just battling your own ego? You decide, folks. But here we are. Here we are. And if that gets put into place, because he can legally do it, even John Roberts said there are other methods, there are other statutes that can be used that they can't say you can't do it because. Now, that's what they've gone out and found. In fact, now he's going to raise it up to 15% globally. You're all going to pay now for his humiliation. Now, here we have it. Now, let's go in and see what are we going to do on Monday. Now he's going to start playing the tariff game. I'm going to show you what I think is going to happen. And I didn't know this piece of news until just now because it came out overnight. So let's just go in and take a look at this. But we have that ongoing. So what my thoughts were is that knocking down those tariffs and basically saying that the United States needs to pay back $173 billion worth of taxes that they've collected, which now the president's saying, nah, never going to happen because it'll just be hung up in the courts forever and ever. I was like, guess what? If it gets all the way up to the Supreme Court and they said, no, you got to pay it, that's your last court, fella. So again, I don't know, but I just think to go on these whims is kind of ridiculous. So the reality is that he is going to put other tariffs in place and he may start raising them. I mean, he's gone from 10 to 15% automatically just because. What if he goes from 15 to 25% just because? Now, depending on what statute he's using, if we're considering that what's being placed on companies is a tax, the authority to put taxes, engage taxes legally, is the United States Congress. It is not the president. Now, the president probably could try to veto what got passed in the House, but the Senate can pass it by a majority, and that's veto proof. Now, so we got a lot of stuff that's kind of going on here, folks, in terms of what can happen with these tariffs. But right now, what we need to deal with is like, oh, he's putting them back in place. I want you all to just sit and think of how many times and what we moved through when tariffs came into the picture, both being put on, both being taken off. Now, so this muted response that we got, that sudden spike that didn't last, and eventually the market did go up and put in a new high. I believe it was here in the NASDAQ, above what we saw from the spike. But is it going to have enough energy? Is it going to have enough power to continue to power the markets higher? I'm going to step out on a limb and say no. All right, so we will continue this. I'm going to weave it into the conversation, but let's just start to see where we are. So again, our largest amount of data that I have right here in front of us, and I have that we're on primary one, primary two. We're still in the process of finishing primary wave three, which I do have a count that could suggest that primary wave three is done. And that would be at the October highs, by the way, folks, October highs. So all of this sideways action that we've kind of been going through right now is the beginning of a primary fourth wave down. As strange as it may feel, that could be the case. And we kind of have to walk past this belief that, wow, there's, such a long-term bull market. If we're really, if the bears are in control, and trust me, it has nothing to do with being bullish or bearish. But if we can tag it, we can say, oh yeah, bears because they like to sell. No, then you can tag that word to what's happening in our market. But to believe that we're going to have a strong downward pressure, that could come from that GDP number, which is real, comes back in, and the world sits and goes like, wow, remember that? Remember how the gross domestic product declined 1.4% month over month or quarter over quarter? Not good. That doesn't produce strong economy. That produces recession. So we got that word coming back into the conversation. What do we think is going to happen? Maybe what we'll get come Monday, because guess what? New tariffs, we're putting them back on, plus the GDP number. Could that be the 1-2 punch that drives this thing to the floor or through the floor? Maybe. So let's take a look. Here we are. Primary one, primary two, primary wave three. Inside primary wave three will be 5 waves of intermediate degree, of which 1, 2, 3, and 4 are complete. Let me bring this down to the weekly chart, 5-year weekly chart, and there we have intermediate 3, intermediate 4, and here we have intermediate wave 5. 5 waves of minor degree to complete intermediate wave 5, of which we have 1, 2, 3, and 4 done, still in minor wave 5. Now, in the NDX, I can work it that I can put minor 5 completing right here. I just need to move that down, move that over, and this becomes wave 5, minute wave 5, etc., all the way up. That is a possibility. In fact, I had counted it that way, but then the market continued to decide didn't know what it wanted to do. It was going to rally. We had all kinds of things going on. And so suddenly everything got put into limbo, but it's still there. And that could be a reality. But what's happening is this is a 3. This is a diagonal triangle up to that high. So what's that leave open? The potential that we still actually have another new high to make first. And that is kind of what one scenario that I'm looking at right now. So this, folks, from that high in February in 2025 to that low in April was because of tariffs. Dare I go back less than a year to tell you about China and the United States barbing one another. Well, I'm going to put 50% tariffs. Well, I'm going to put 100% tariffs. Well, I'm going to put 145% tariffs. On and on and on, like two kids slinging mud in a sandbox. But this is like two massive countries with huge economies. Okay, so we saw what happened. This rally kicked off because, number one, President said, gee, I think it's time to buy. And number two, made an announcement that he was pausing all the tariffs. Bam, rally. Unstoppable. Why? Well, because we had a minor fifth wave to finish. So all kinds of negative. We got all kinds of stuff going on in here. Now the market's having all kinds of trouble getting itself up there. But oh, well, we're going to still rally. We got all this room to go. That part is true. But now we have to figure out what's going to create the situation that's going to back it up. Granted, we have had great earnings reports all through this whole run up, quarter after quarter. Well, everybody's they're making money. Everybody's still booking tons of money. Granted, that is happening. But with a lot of warnings from CFOs and CEOs, a lot of warnings that it's not sustainable, that they see, rain clouds ahead or whatever you want to call it. But that hasn't stopped them yet. Now, it might. GDP just might knock it all back down. This part we have to consider and realize is true. You can't doctor numbers and expect the world to believe them. The market might, because we got a bunch of algorithms that are just going to react. But the reality is, when the reality comes out that they're not true, all hell will break loose. So here we are. I'm going to bring it out of there. I'm going to bring it down to the daily. Now, here we are looking at this. Okay, so there we are. 1, 2, 3, 4. And this was very extended. Oh, very, very extended. This third wave. But it was to allow for additional highs, which the market was hell bent on doing. And that was a decent rally. But then it started to put in a diagonal. And it's not even the cleanest. Here on the NDX, yeah, I can do it. 1, 2, 3, 4, 5. Minuet, wave 1 of minute wave 5. I can do it. Now, I'm going to open this up in a minute, and we're going to see both reactions are right there. Look at how small that candle is in terms of the whole thing. But boy, that unleashed Pandora's box, didn't it? Oh, yeah, we got those tariffs, and now we got this, and we got all these markets have just put in these lows, and we're going to the moon. I would think we're going to start a little bit stronger than that. And don't get me wrong, that could happen if we didn't have this talk going on the other side. Oh, I'm reinstituting. In fact, I had 10%. I'm raising it 5%. Ha 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 on all of you. Okay. So now we got a 15% tariff. What's he saying really? Why? Why are you doing that? Because they've been so horrible to the United States. No, they haven't. They've been pretty good trade partners. What happens within the United States because of how the government's being, what's going on within our government. It's not up to us as individuals to control inflation. It's not up to us that we work in an economy that constantly demands more money. Think about it. You can't have your cake and eat it too, folks. One produces inflation, the other one produces recession. It's a natural ebb and flow. And unfortunately, we're going to flow in the other direction based on what I'm seeing coming through. GDP, gross domestic product. That's a definite just because of the tariffs as they exist. So that's one of the reasons we got a spike, right? If they take them down, then we should be able to get our products out there without. But we can't get the products back in, which supports a global economy because they're so unfair to the United States. That's not true. That's not true. We're buying, they're buying. So what really does it come down to? The corporate structure, really, just come on. We all need more money because the houses cost more money, because this costs more money, that's more money. We need it to live. And suddenly we have so many different things that are becoming profit centers. So, it's a game plan that just is not going to stand up to time. It's been in place for a while, and it's been a glorious run. But it's time to correct. And it's time to correct all of the ails that go behind it. i.e., the United States debt. We have funded more garbage in this country than I don't have time to talk about. Now, I know I might be sounding a little bit more political, but folks, let's just be real here for a moment. $38 trillion of debt has been sold to the world so that the United States could reign supreme. Guess what? It's time to pay it back. It's time we've got all these loans that eventually the large countries that hold our debt may decide, you know what? We no longer have faith in the credit of the United States. And therefore, we don't want this debt anymore. And guess what happens if they start to sell it? What are they going to be selling, folks? They're going to be selling our bonds, the treasury market. And what happens when that begins and it starts to avalanche? Do we think that interest rates are going to go down, or are we going to have a president that's going to be screaming and ripping the doors off of the Fed meeting to say, you must lower that Fed funds rate to 1% or lower? Really? That's not going to happen. If they're selling our bonds, who the hell do we think's going to buy them? Because we're going to have to give it away. We're going to have to give money away for people to take it so that we can get money. That's all we're doing, selling our debt to raise money. And this is just something that just is not going to be good. And it's going to take a long time. Cycle 4, duration, I don't know, 9 to 15 years. What we need to do, folks, all you need to do, just kind of go back out here for just a moment. Well, let's look at this. Here we have from October of 2022. That was the bottom of intermediate wave 4. Intermediate wave 5, nothing. I mean, we can go back. I got to go back out. I got to even go back out to this one. That's the pandemic. But I can go back further. Here is the great financial collapse that's shown in the NASDAQ. But what started here, but what started there? We had to bail out corporations. So the federal government came up to the task and was successful in stopping the bloodletting. Remember what happened during this great financial collapse, folks? Lehman Brothers closed their doors, Bear Stearns closed their doors overnight. Overnight. No warning. Just went out of business. Banks were absorbed, big national banks. Bank of America, Wells Fargo, they were taken over by smaller regional banks. We were in trouble. And it all got bailed out. And we started with TARP, which, by the way, all got paid back. So, but then we went on, and then you see all this wonderful recovery that we had coming out of that. Then we had the pandemic, right? You can't go outside your house. I have to work. Sorry, not going to happen. We nosedived again. But what did we have to do? Here we had to bail out corporate. What did we have to do here? Bail out retail, people, us. And we got bailed out. And that then gave us this run. But then at the same time, interest rates were so low and so much cheap money sat out there that it was not sustainable. What happened? Interest rates went up. We declined. Now, that was an intermediate fourth wave. What am I looking for now? A primary degree fourth wave. So where do I think we come back to? At least that level, a primary fourth wave, I think we come back to the 2022 lows, if not the pandemic lows. That's where I believe we come back to in this correction. Well, how can that happen when we've got so much good news about AI and blah, blah, blah? Mm, well, yeah, but it's not going to be enough. We can't just sustain a $38 trillion worth of debt and add to it because we're going to add tariffs to countries that supposedly do trade with the United States. And during the original setup of tariffs, our trading partners have now formed new relationships with guess who? Yep, you know it. So do I. I don't need to say it. But they're not going to rely on the United States. The instability in the United States are not going to rely on it anymore. Well, what does that suggest? We continue to build on ourselves? How? We're just got to be adding to that debt. Let's not forget, it's just not out there every day. But the three major rating institutions, the credit rating institutions, have downgraded the United States. Not our banks, the United States itself have downgraded it. It's forgotten. They're like, oh, yeah, our credit's good. It's shaky, folks, because we'd have to keep printing money and start giving it away at lower rates. So, well, we got to replace the current Fed board because they're not doing what the president wants. Okay, so what are we going to do? We're going to go into a recession. Oh, is that what the president wants? Or if he thinks that if we drop the Fed rate to 1%, that miracles will happen and we won't go into a recession because we'll be giving away so much money. Then who's going to buy our debt for a 1% return? That's kind of like I have shaky credit. I've got a couple of defaults here and there. I'm not really doing that well, but I want to borrow $150,000. I want to do it at 1% because I need this house, right? How many commercials have you heard, folks, for new cars? 0% interest for 9 years or 8 years or 7 years or 5 years, whatever the situation is, for very well qualified customers. If you're not well qualified as a customer, yeah, you can still buy that car, but your interest rate is going to be 15%. And if you need money to kind of live on, well, those interest rates go up to 30% to borrow that money. Yeah, come on in. So the good faith and credit of the United States is waning. The big break here that's going to happen, and it's not a matter of if, it's a matter of when, is when the globe, and it's going to start. Could be China, could be Japan, could be the European Union, could be the Great Britain, it could be one of the countries. But they're going to start selling our debt. They're going to start selling it. And what happens when the bond price goes down? The yield goes up. That's interest rates. All right. Enough said there. Let's go to talk about well, what can the market do from here? I do believe, let's just play out the scenario because it gets sketchy when we have to start adding all the other things in. Like A, here's the next one, folks. Let me get over to that. It's right here. So Trump orders major military buildup toward Iran while advisors push economic agenda. What economic agenda? What economic agenda are we pushing? Seriously, one that doesn't include us, obviously. So we're going to go attack Iran because they haven't agreed to a nuclear deal within 10 to 15 days. This, this is what's in control, right? What's going to happen? While the economic advisors are pushing an economic agenda, what is that agenda? Tariffs? Good luck. All right, I'm going to bring this down. I'm going to bring it down all the way to the daily. And we're going to go to the internals of what we got because I'm postulating here and I know that I'm going on. But minor wave five, five waves of minute degree, of which I have one, two, three, and four in place. And wave five is weak. Now, remember, they're all kind of alternates. I do not have a preferred. They're all alternates. But one of them is right there at the October 29th high. That completed all the way up to primary wave three, which puts us in the beginning stages of primary wave four. And this could be A, and this could be B, by the way, folks. It could be B. And it's because I can put that as A, and this is A of B, A, B, C, B of B, C of B, and I could put a B up there. I know what are we working on coming down? Five waves. It's possible, but I'm going to show you how both sides sit there waiting. And I think come Monday or next week, we're going to find out. We're going to find out. I think it's going to be that short term. We're going to find out real quick with all this new stuff. Because remember, remember saying it's like we didn't really, we spiked, but boy, was it momentary. Boy, was it momentary because they brought it right back down. I wonder why. Why didn't we believe that that was a good thing? Well, we're getting ready to go start a war with Iran to demand that they come to the nuclear table and talk. And what are we willing to risk? Stability in the Middle East. Oh, what's behind that? Oil. What's one of Trump's big deals? Oil. Okay. So here we are. That could be wave five. And this could be A, and that could be B, and we're starting a C wave down. And I promise you that that C wave would likely be disastrous. Now, what are our levels here in the NASDAQ that could prove to be very damaging to the market? Right now, it's 24,000. 24,000 for the longest time has held a large gamma position. I don't know that they've moved it. I don't know if it's all expired. I will find out come Monday morning when we see the new levels being produced. But I would tend to believe that 24,000 should remain, or it could be moved lower, in which case they're giving themselves room for this market to drop. But right now, accordingly, I thought a break below 24,000 could start what I would call an avalanche of selling. An avalanche of like, uh-oh, no, we're out, go, start selling. And it just starts and it rolls. Now, on the 25th of February, we have NVIDIA's earnings. There are a lot of people that are resting on that one being glorious and wonderful and just driving the market higher. We have now watched, folks, let's just play reality here. We have now watched Amazon, Apple, Google, Meta, Microsoft, Tesla all report great earnings, get a boost and a drop, all in the same hour, and then get taken to the sewer. But now they've all bottomed and they're all recovering off of that bottom. Okay, well, yeah, everything bounces. We used to call it back in the day, right? I'm old enough where we were on trading floors. What is that? It's a dead cat bounce. And you know what the theory behind that was? You take a cat, dead cat, off of a building and you throw it, it's going to bounce. As disgusting as that is, a dead cat bounce. Now, could we get that? Yes. What's going to be the result? Doesn't last. It turns and it collapses. Now let's open this up a little bit more. I'm going to come down to my hourly chart. And here we are. So let me stay on that daily for just a moment. And we're going to come down. And let me just tell you how I've got this laid out and why. Because I am giving the benefit of the doubt to the market that they will have, or glean something out of what took place on Friday. And I'm not even going to Monday to say, now we've got additional news that may prevent that from happening. So what does that suggest? Well, if it does, and this is A, and I'm going to leave it as an A of 4, right? We're going to leave this 3 in place and say A of 4, and this is B of 4, and we're coming down in a C wave. And if that's the case, you run something just like this, and we go out like that. And what do we have? 2308, and that's just 100%, where wave C equals wave A. What's 1.618? 22,347. Well, that still could work because if I go back out to my other chart, well, the fourth wave is not really threatening wave 1, which is all the way back on April the 9th. That's the high of wave 1, April the 9th. That's way down there. So there's still room. And what this would suggest then, right? If this is still going to be minute wave 4, then that fourth puts that low in and we explode higher yet again. Now you're going to have to balance that against what is realistically happening around us. If we don't have any supportive stuff, rallies are going to be very short term. We have nothing to hang our hat on to go like, okay, let's build on this. Because moving forward into the second quarter, we got some good stuff coming. You know, unless that changes. So think about the economy, think about stuff, and not just like, well, Elliott tells us this. I can give you Elliott counts that show you we're going to the moon. Doesn't mean it's going to happen. So, you know, and I agree that I try not to even get caught up in that because well, you know, we should have this rally. But what happens if we don't? That's why we have alternates. You better take a look at both sides because the reality is that one or the other is more likely. So, and we're getting a whole bunch of stuff. Just follow the news that can affect the market. And the canary in the coal mine. I can't, I'm trying to put emphasis on this and not try to be funny. But the canary in the coal mine, folks, is treasuries. It's the US debt. It's the treasury market. Please don't let it go. Please don't forget about it. It's going to sneak up. It sits quietly. And basically, we're watching this, which there are still people out there that go flight to safety. There's safety in the US bond market. Well, that one doesn't go anymore. But still, people are doing it. Institutions are doing it, but they may just be parking temporarily. Now, we can't count on what we see as being long term. That one, you can. Gold. So back to the market. So if I have this one, then I'm thinking that, well, we got this. Okay, so that's wave 1. So even if I'm coming down in a wave 2, I have an A, B, C, X, A, B, and we got a C wave down. That, by the way, now I can bring it down. Let's bring it down to the 4-hour chart and open this guy up a little bit. Okay, so what do we have? That was all the news. That was, oh, GDP, plop. Oh, tariffs, run. And then we didn't even do well. This was Friday just before our open. This was Friday from 10 a.m. on. So that was the secondary pop from the tariff news. This was the first of nosedive from the GDP, rally back. Actually, I think that may have happened prior to the market. Then we got the news. So they'd already started down. And but it didn't avalanche. It walked its way, walked till it reached that. And then we were rallying back. So this actually came, and I think we were down about 24, yeah, like 24,876 again in the cash. And bam, we spiked up. But then we ended up here. Why? Because of expiration, would be my take. Now, if this is indeed, we're still giving hope that this is just a wave two. There we have the ABC for the first one, even though most people are going to say that looks like a 1, 2, 3, 4, 5. And you can put it in as a 1, 2, 3, 4, 5, and it still would be wave A. And this still could be wave B. And this still could be wave C. 1, 2. And we're going to drop in a third. Just saying. We can put it this way, which is going to lessen that blow, or we can put it in much more severe. Much more severe. In which case, this could be still 4, and this still could be 5, and it comes through. I can put the finishing marker there, and that could be A, and that could be B, and we're in a larger C wave. Now, that keeps it in more of a corrective mode where we still go back up. If I'm going to put it there that it's all done, I can put it over here. And we still had a diagonal. Now, here in this actually should come down because it did. The wave 3 here did make a new high over wave 1. Not the longest, but it did make a new high over wave 1. And wave 5 did come in. So I can put it there, and you'll notice that it's just a much, much smaller failure. So there's also that possibility of putting it here. The diagonal stays in place, and this is wave 5 of 5 of 5 of 3. Then what are we doing? The A wave down, and it's going to be 1, 2, 3, 4, 5, wave 1 of A. ABC, wave 2 of A. 1 of 3, 2 of 3, 3 of 3. What does that tell us? We come in tomorrow and they're already going to knock this sucker down. And by Monday, we are going down. And it could be in the third wave. Now, what does that tell me? Well, we've got 23,801. I got 22,347. Now, if I'm going to come down, I've got these. Now, let's just kind of fill those in. 1.618, 2.618. Let's just do that. Here we go, 22,447. And that's just for this third wave. 1, 2, 1 of 3, 2 of 3, 3 of 3 could. It could. I'm not saying it will. It could. Okay. I'm just giving you potential. Depending on how you want to look at this market, depending on how we want to label. So this one, and here if we have that, if this indeed is a minuet wave 2, folks, right in here, it cannot break below 23,854. Cannot. Wave 2 would then be going beyond the starting point of wave 1. That invalidates that count. Keep that in mind because you're going to have your alternative already if that occurs. Now, this is the cash market. If I go over to the futures market, it's going to look a lot worse because this did not take out the high in the NQ. And this is way above this because of the futures market, because of the premium in a future to when it first came online in October, right? Because that's when that would have been. All right. So there's your marker. If we start coming down with any force, we cannot break below 23,854 and continue to count this as a wave two. And this is a wave one. So if we start to break, you're going to get your clues real early here, folks. It isn't a matter of like, well, we're going to let a little bit more. It's going to turn around. No, 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 no. I would suggest not doing that because you won't be the only one that's going to be selling if you're long. There are going to be a lot of sellers because we're going to be breaking gamma levels to get there. And the biggest one being 24,000. 24,000. And you see how this all spreads out? Because if it breaks 24,000, it should open a little bit of an avalanche there. A little bit of a like, get out of the way. We're going to hit the bids. Now, we have Monday is the 23rd. Wednesday is the 25th. NVIDIA's earnings are due. I can't tell you what they're going to do to the market between now and then because we have news. We have developing news on several fronts, tariffs and Iran. We have several fronts that could really affect what this market's going to do. Okay, so I'm just saying be open to this is not going to happen. The upside's not going to happen. I don't care what NVIDIA reports on Wednesday. Then an algorithm, I'm sure, if they come out with decent earnings, you're going to see a spike in the stock. You'll you'll see a run in these. But what if it's running from down here, right? And they take it up to 199 or 200. Okay, boom. And then suddenly go like, man, that's not going to last. Boom. And take it down to 170. How many times have we seen that one, huh? So again, count on nothing. Count on what you can hold together and then have to let go of when it gets invalidated. Okay? So that's kind of the thing. If this is A, B, the C wave can come down to here and still break 24 or hold up 24 right there. What it can't do is it can't break there. So what's that tell you? It can't hit this 100%. It's got to come in higher. It can hit 100% here, 2407, 74, excuse me, or even here, because that's below the C wave, and that would be below the A wave, and that's 24,304, I want to say, up in here. And that could work. Complete the second C wave, put it two, but if can't we sit down there? You make the bottom and you rally. That's the name that should happen. So we're at a very interesting point here. So let me just go over to the NASDAQ because I want to show you the differences that we have here. Um, for the longest time, I had with this third was below that one. And then suddenly, I'm serious. Suddenly, I'm like, why did that change? But it did. But I don't think it's that strong. And people are saying, well, wave three is the shortest wave. It's like in a diagonal, that's okay. But if I look at it against wave five and it comes in as the shortest wave, then it's not okay. So, and I believe that might be the ticket, but I'm kind of leaving it there because one way or the other, either this is, oh boy, that's all a mess. We have minute three, minute four, minuet wave one. Otherwise, I have three, A, B, and a C. And we got to come over here for wave four. Now, in that case, if it's still a part of this wave four and that's an A, we're looking for it to go below the wave A. If it's staying here as a wave two, it cannot go below. Same deal. 23,927 cannot go below. And we already have markers to tell us that it could, both in terms of moving lower here, A, B, C. So we have the C wave and we have the whole ABC together. Thus, can get below there, or it can stop here and save itself. But then again, now if we're looking at that for, I'm looking for it down here. If I'm looking for a wave two, it's got to come in up here. So if I'm looking at the possibility, this is the other one. This is 26,379. If this is the high of highs, this is 26,287. So, 90 bucks. Not the biggest of failures, but still, you know, enough where you might want to say no, but that could be a 4 and this diagonal, which doesn't fit, right? Doesn't fit in the futures market. It fits in the cash market. And unfortunately, what I will say, cash will rule. Cash will carry the count. So that's why I spend as much time as I did over here. Because this is what I'm going to work off of. This is cash. Doesn't have premium. It's real. These were the prices. And that is not, it's such a small failure. This is 26,165 and this is 26,182. Wow, I can handle the $15. I can handle that in terms of, a failure. Very small. In fact, it does kind of lead me to believe if we are an A, B, C coming down, it should be pretty flat. So it should hold above 23,854 and be an absolute flat, an A, B, C flat. If not, even as a wave two, it needs to hold above that 4 because that's the starting point of wave one. So we got some major things all being put right there to that low. And if we come in tomorrow and we're starting to slide, you've got your point. And you can use the futures market to give you that point, which is going to be right there in the futures market. It's 23,927. That's the marker. Don't break it. Now, if it's an A, B, the C wave, sure. I'm looking for it to come down below the A. Okay, then I got this. But if it's this count, you cannot, because that's the starting point of wave one. This wave one. And you can't come down below it. So that's the deal. That's the very short-term plus long-term picture. Everything that I got, I'm now putting out to you. Why I think the way I do, what I'm looking at. And again, folks, you hear me talk about it every once in a while. I really need to bring it back. And that's what I call my own personal pecking order. What sits at the top of that pecking order are interest rates. It's all about what is the cost of borrowing and what do I get when I do lend? The cost of lending, the cost of borrowing. What do each of us get? So now, how does that roll down? So we have interest rates sitting at the top of the pecking order. We have next down is the dollar. Because interest rates, what you get, are either way, going to affect where the dollar is going to trade. What comes next under that? Corporate. Corporate comes underneath all of that. What's going to be the price of these stocks and these companies? Well, interest rates. The cost of borrow, the cost of lending, going to make a big effect on what corporate world does. And then what sits underneath that? Retail. Me and you, folks, everyday people. We're at the bottom of that rung, but the fallout rolls all the way down and hits us usually the hardest. So that's why, and it just amazes me that there's not more talk about the debt. We're hiding it, all right? Distract people. Don't let them think about that. Okay. But at the same time, oh, I'm not going to go there. Sorry, I was going to go somewhere. I'm not going to do it. I'm going to wrap this up. And I want to thank you very much for listening. I want to thank you very much for hopefully gleaning some stuff out of what I'm bringing in to help me determine where are we in this rally phase, if it's still going on, or where are we at this beginning stage of a larger, more dangerous decline, and what can affect it. Next update will be on Monday morning.